Hello guys, welcome to today's session in Quantsapp, and today we will be learning about mutual fund demystified. It means we have simplified mutual funds for you in this video. But before starting the video, if you are new here, you can go in the description. There is a link below and you can download and install the wealth application of Quantsapp. After successful registration, you will get some free tools in the application that you can use for your investment purpose. Okay. Also in the application, there is a video library in which there are so many videos, a pool of videos you can say, in multiple languages, and they have covered multiple strategies and multiple Pro Plus tools for you. Now at any point of time, if you are having any kinds of doubts or query, so you can contact us here in this number, okay, and we will be there to sort your queries out. Right, so let's start today's video, that is mutual fund demystified or simplified. Right, so it is basically a beginner's guide to investing. Right, now when we talk about mutual fund, so the first question is, what is mutual fund? Right, so when we trade, for example, when we are taking or when we are buying a stock of a company, okay, so what we usually do, we buy a stock, and when we buy a stock, that means we are now taking ownership of that particular stock. Either you will buy 1% or you buy 20% or you buy 50%, you are owning the ownership of that company, right? So whenever the company will get a profit, it will be divided to you guys also, right? Similarly, when you are going with a mutual fund, so in mutual fund, there is, you can say, a fund manager, right? So he collected a pool of money from the various people and invest that money in, you can say, sector, in assets or in bonds. And from them, the profit is generated, and then that profit is distributed to you, right? Let's see the definition again, okay? Just wait. Right, so here you can see what is mutual fund. So mutual fund is a pool of money collected from many investors, as I have told you, okay. It is managed by professional who invest in stocks, bonds or other asset, and we also call them the fund managers. Now the fund managers can be of various types, okay. The mutual fund can be of two types. It can be active or it can be passive, right? We will also talk about it. Now the key point is, you own a small part of the entire portfolio. For example, if they are making money with that portfolio because they are having a lot of money from various people, right, and they are investing it in stocks, bonds or other asset. Right, now when the profit is generated, so you get some a little amount of profit from that portfolio, right? It depends on how much you have invested. Right, now when I was talking about the fund manager, so it can be of active types or it can be of passive types. So first of all, active, and it can be of passive. Now what is the difference between them? Right, when I talk about the active, so these are the fund managers, the people who invest in aggressive stocks or you can say sectors, right, because they generate a good amount of money. So there the growth is very fast, okay, and the profit is high. But at the same time, it also consists of a very high risk. Now what they do, they keep on buying and selling according to the lows and high of the market, right? And at the same time, they go with different kind of researches, right? They manage your portfolio, okay, very actively. In the when we're talking about the passive, so passive are those fund manager who thinks like they just want to match the returns of, you can say, an index, for example Nifty 50, right? So for example, if Nifty 50 is providing you 26%, so they just want to replicate that 26%. But in active one, they want more than 26%, because they think like in Nifty 50 there are 50 stocks, right? And out of these 50 stocks, much of the profit comes from 2, 3, 4, 5 stocks only. Right, so they think that if they will be able to find a good stock, they can make more returns in comparison to Nifty or any index in a year. Right, so that is the difference between the active and passive. So that is the fund manager for you. Okay, now let's move to next PPT. Okay, So how do mutual fund work? Okay, now we are going with how mutual fund works. Okay, so investors contribute. The first point is investors contribute money to the fund. Okay, so as we have seen in the first slide also, the fund manager, they takes money from the different people. Okay, and a pool of money is generated, and then that pool of money is invested into something, right? That can create, because a big capital is able to provide a big profit, right? So that is what happened. Investors contribute money to the fund. Okay, now the fund managers that we were talking about, they decide whether to invest based on funds goal. Okay, now in active or passive, if for example, let's say there are two types of fund manager, that is first one and that is the second one, right? Now the second one, he must be thinking that he don't want to take the risk because there are so many SABI's rule and regulations, right? And also if he will take the risk, and by any chance he will get to face losses, so at that time it will cost him his income, his job also, right? So that fund manager's job will be gone, you can say, right? So that is why they go with the safest option. They invest in the type where the liquidity is maximum, where the maximum number of people are investing, or with the stocks which are in a good growth, right? They don't take any risk. Now then there comes the second one, who actively research, they take risk at the same time. Okay, and that is the difference between the funds managers goals also, right? But in this case you will face high risk but high profit. There are chances. In this there is a moderate risk and moderate profit. It is useful when you are going for the long term plan, and this is useful when you are going for the short term plan. In the short term you will able to see the good profits margin, right? So that was it. Now if I'm talking about the return, so profit or loss are shared among the investors. So if you will get the profit, it will also be shared with you. Okay, so the profit can be shared by two things also again, right? Then one is the IDCW, okay, and one is the growth. Okay, now what is the difference between these two? For example, this is the income distribution cum withdrawal, okay, IDCW. Now in this, what happens whenever you will get a profit, so it will be distributed among the investors. For example, you have invested 5%, so whenever there will be a profit, so you will be getting that profit in your you can say mutual fund account. Okay, now for example, a person who is investing 10%, so he will be getting 10% of the total profit, right? Similar, but in the growth, what happens if this company is making a profit of 10%, so instead of giving it to the investors, okay, what it will does, for example, the total amount it collected from the investors was X. Now it is getting a 10% profit on X amount. So what it will does, it will just compound it, okay, and it will now the total investment is X plus 10% of X. Okay, now it is the total investment. So this total investment will again be reinvested, but it will not be given back as a profit to the customers or to the investors, right? So it will be given to you at the end of your investment journey. Okay, so till then it will get recompounded. Okay, you will get profit, again that profit will be reinvested, then you will get profit, then again it will be reinvested. So it is a thing that will increase your principal amount. Okay, so that is one of the thing here. Okay, now let's get back to another PPT. Okay, so types of mutual funds. Now we are looking into the types of mutual fund. So first we can say equity funds. Okay, now equity funds are those mutual funds in which they invest in stocks, you can say shares of various companies. Okay, so for example, Reliance, there are multiple sectors, IT sectors, infra sectors, oil sectors, medicine, pharma, you can say many. Okay, so equity funds are those funds which invest in stocks, right? In equity funds there is a chance probability of high profit. Okay, high profit, but it is also impacted by the market volatility. So high profit but comes with high risk as usual. Okay, so high profit but high risk. Okay, so it impacts with the market. Okay, now when we are talking about the bond funds, so it comes in the, you can say, debt funds also. It is also known as the debt funds. Now in this, invested in the bonds, you can say, or treasury bills, or you can say there are many things that is related with the companies and government. Okay, so in this is called the debt funds, or you can bond funds. Okay, so treasury bills, bonds. So when the amount is invested in these kinds of things, that is known as the bond funds, right? Now in this bond funds, the profit is limited, okay, or you can say low profit, okay, but at the same time low risk is also involved, right? Now balance funds, so a mix of stock and bonds is called a balanced funds. Okay, so many of the fund manager decide to go with the fund balanced funds. Okay, or you can say there are multiple things also. For example, multi-cap, you can take the example of multi-cap, in which it divides its investment percentage in a fixed ratio. For example, 25 in this one, 25 in this one, and 25 in this one, right? So your overall investment is divided in equal parts. Okay, then we have the index funds. Now index funds, it is a mirror of stock market index like S&P 500, or you can say Nifty 500, right? Also, okay, so they replicate the index performance, right? So that is why they invest in these kinds of indexes, right? So these are the type of mutual fund that you can invest on if you are going for the investing, right? Okay, now let's see ahead benefits of investment in mutual funds. So सबसे पहले तो क्या रहेगा, professional management. So first thing is that your account has been handled by the professional management, so you don't have to care about it, because they go with very deep researches. Okay, they see like which type of company is doing good, their condition, their management, their quarterly report, the profit generated, the loss, their yearly annual report, CAGR, everything. Okay, and only after that time, only after those results, okay, they will invest your money, right? So experts manages your money. Then we have the diversification. For example, if you are investing, if you are trading in a stock, or if you are investing in a stock by yourself, right? So what happens if there will be a volatility of the market? First of all, you will not be able to get the data, or you will not be able to find the overall synopsis of all total market, or you can say 185 future and option stocks, right? So there are so many stocks, so you will get confused, right? But when we are saying diversification, okay, so what happens, these mutual funds manager, they invest your money in a diversified manner. For example, they will choose different stocks from different sectors which are playing good, which are doing good, which have name, okay, which are providing dividend at the same time, okay, performing well from the last few years, okay, and that is how they diversified your portfolio. So that if at any time, if there will be a bearish market, if there will be any bearish movement in the market, still then your profit will get average, and overall you will not be in the loss, right? So this is the diversification for you. Affordability, okay, the third point is the affordability. So start investing with smaller amounts. Okay, for example, if I take the SIP, so in SIP, and then there is a lump sum also, right? So in SIP, you can start your SIP in 500 rupees also, right? So it provides you that much authority also. For example, if you are buying a stock, so if you buy a stock for 100, for means 500, okay, so you can see there will be not much momentum for a day, or 2 day, 3 day, if you're in trading for that. Now if in SIP you just have to invest 500, okay, or you can invest more than 500 also, but I'm telling you the minimum amount. So you can invest 500 per month, okay, and after few years, and you don't have to care about anything like for the market volatility, because everything will be taken care of, right? Now this 500 every month will be recompounded, and you will get a good result, or you can say profit, okay, or returns after few years, right? So you need smaller amount if you want to start investing right now as a beginner also. Okay, now I was telling you about the lump sum. So lump sum is that for example, if we are having a large amount of money and you want to spend it at one go, so you can do that also, right? Instead of going with the 500, then next month 500, you can invest, for example, 5 to 10, 15 lakh rupees at one time, and then you have to wait for 2 or 3 years, and you will get a good return on that also. Okay, so that is lump sum for you, where you invest a huge amount of pool of money at one go, and in SIP you invest in a manner, or you can say at a particular time intervals. Okay, so This is the thing. Now if I talk about the liquidity, to easy to buy and sell, why it is very easy to buy and sell? Because there are so many people who are interested in it. Okay, there is so much money that is invested from the mutual fund, so that is why the liquidity means the participation. Okay, so the participation in mutual fund is already so much diversified, or you can say so much participation of the people, that there is no need to worry about like if it will if there will be any problem in buying or selling. So you can easily buy and sell it at any time when you want, right? So there is no issue of liquidity as well, right? Okay, now let's go ahead here. Okay, so I have told you about the benefits. Now after benefits, let's see what are the risks that are involved. So first of all, the market risk. Okay, the value of investment can go up or down. Now there are three kinds of market here. First we talk about the small cap, then there is a mid cap, after mid cap there is a large cap also. Okay, now in the large cap, mid cap and small cap, if you are investing in small caps, so they are the company which are making very good profit, but because they are taking huge risk. So if you invest in these small caps, if your mutual fund or fund manager, usually they don't invest much of their amount in small cap, but still if they are doing so, okay, so there is a high chances of risk involved in small caps. Okay, so because it impacts with the volatility also, right? But are capable of providing you a very good growth at a very shorter period of time, right? So this is why the risk involved. When you go with the mid cap, so it provides you moderate risk, moderate profit. When you go with the large pro, so it will give you low profit, but at the same time the risk is also low. So that is why major of the fund managers go with this type large. So 66% of their capital is invested in the large cap, right? Okay, now fees. So if I talk about the fees, so let's see what are the fees that are involved. So first of all, there is entry loads. Okay, but these entry loads were removed by the SEBI in 2009. So now most of the mutual fund there is no entry loads, right? But when you talk about the exit loads, so exit loads, when you are taking the profit, when you are exiting your investment, so at that time you have to pay 0.45% to 0.45% to 4%. Okay, so it can be vary between 0.45 to 4%, right? That is your exit loads. Okay, it depends on your returns also, right? So this is the first thing. Then there are expenses charge also. Now in expenses charges, we usually include the management charges of your fund manager. Okay, how actively he is participating, how well he is maintaining your portfolio. So that is all covered in expense charges. If your fund manager is active, he will charge you more expense charges. If your fund manager is passive, he's not doing much work, not much research, so then your expense charges will be less. Okay, that is the thing. Now then we have, okay, so we have covered fees. No guarantees. You may lose money if the market performs poorly. So as always, because if you go with the stocks, if you go with the trading, okay, if you are investing, so all of these are dependent on market. So eventually they are not risk free. So you must be ready to take some risk when you are trading or when you are investing. So that is one of the things that is included, but you can always minimize your risk with the proper strategies and proper research, right? That is one of the things. Okay, let's go ahead in the presentation. So we have talked about risk, how to choose a mutual fund. So first thing is that you must be clear about your goals. Like what are your goals? If your goals are for long-term plan, okay, then you can choose your mutual fund accordingly. Okay, so what are you investing for? If you want for retirement, so you can go for a long-term plan. Okay, in the long-term plan you can choose growth also. Okay, a house, if you're planning for a house, so you must be needing the money within 2 to 3 years, so you can plan accordingly, right? So if you are going with this one, so what you can do, you can go with the short-term plan. Okay, short-term plan. Now when I'm talking about short-term, so I got to know one thing. Okay, there are short-term capital gain and long-term capital gain also. Okay, when you are going for the short-term capital gain, so there are some charges included, that is 15%, and in the long-term capital gain, that is 12.5%. Okay, sorry, it is 20%. Okay, it is 20%, and in the long term capital gain it is 12.5%. So that is what you have to keep in your mind. Okay, now I was talking about short term. So if your plan is for the short term, that you can go with the IDCW type of plans. If you are planning for the long term, then you can go with the growth one also, growth mutual funds, right? Risk tolerance, how much risk can you take? Okay, if your risk taking capability is good, then you can also go with the small caps or one who are trading actively. But if you want low risk, then you can go with the passive mutual funds also, right? Okay, now fees. So you must be well informed or well educated about the fees also, like if you are going with some fund manager, so how much fees he is charging from you. Okay, so you must be aware about that. So check the expense ratio also. Okay, expense ratio is the total expense amount the fund manager is charging from you, okay, out of the total capital or total investment you have done. Okay, so that is the expense ratio for you. Okay, and at the last, the performance. So look at the bonds funds past performance, though it doesn't guarantee future returns. So when you are going with some mutual fund, just go like how much return it has been providing in the past. Okay, because usually what happens, if a fund is providing a good returns in the past, it means he has a good market value, so in the future also he will be providing you that much. If a fund is taking risk from in the past and providing a good growth, okay, so it means he will also in the future also he can take the risk as well. Okay, but it is not guaranteed as well, right? But you have to keep that in mind for you. Okay, right? Okay, let's go. Okay, now how to start investing in mutual funds? So you just have to open an account in mutual fund or brokerage, research and select the fund basis on your goals and risk tolerance. But usually you can just skip this one because nowadays everyone go with the fund manager. And then invest regular monthly contribution. So you have to invest regularly for because if you want a good growth in upcoming time, so that is one of the methods that you have to invest regularly and monitor your investment over time. Yes, this is the very important. Even if you are having a fund manager, just monitor its performance over time. Okay, and if he is good for you, if he is providing you a good return, then you can stick with it, or you can change your plans also, right? So this is one of the things that you have to see on a regular basis. Right now, the common mutual fund, so that is NAV, that is the net asset value, the price per share of a mutual fund. Okay, then we have the expense ratio, as I have already told you, and the last one is the dividends. So dividend is the part of the profit that is provided to the investors. Okay, so I have told you in the starting, for example, if a mutual fund is making some profit, so it will be divided among the investors, so that is the dividend for you, right? That is the dividend, right? So I think we have covered almost everything. Okay, so yeah, there are the final tips for the beginners. So for start small, invest regularly, and keep a long-term perspective. Long-term perspective rakho apna. Okay, that will provide you more growth, right? Don't panic during market dips. It's a part of investing, right? So you don't have to panic whenever there is a dip in the market, because that is a part of the game, right? And the last, rebalance your portfolio periodically based on your goals. So you can rebalance, you can invest when the market is at low also. Just maintain your portfolio, keep in touch with your fund manager. Okay, okay, and do like keep researching yourself also. Okay, so that is how you can make a good portfolio investment, right? So guys, that was it for today's video. I hope काफी कुछ समझ में आया होगा. म्यूचुअल फंड का एक ओवरऑल ब्रीफ आपको मिल चुका होगा, एंड काफी लोग जो होंगे वो रेडी भी होंगे इन्वेस्टमेंट करने के लिए. ठीक है, सो थैंक यू सो मच फॉर योर टाइम. दिस इज योर ट्रेनर अंकित सिंह रावत. हैव अ वेरी गुड डे.